Thank you. Senator Gignac, over to you.
Thank you, Chair. I just want to be back on that topic of variable rate fixed payment because OSFI chief last week mentioned here publicly that this product being dangerous. And I think that employees of the banks, most of them, has recommended during the pandemic to their clients to go with variable rates because it was 1% lower than fixed, and no central banks see interest rate going up, inflation and so on. So and you could have a fixed payment. So my question back to the chair: they have some fees when you want to renegotiate because you will be screwed. You have signed for 25 years amortization. No way you are able to have a jump in the payment. So usually you have a fees if you change the contract. Your association be ready to recommend to your members to have a moratoire on the fees because clients have no ability to change banks because the B20 rule apply and they will not be eligible for another bank. So my question, Bank of Canada provide a lot of liquidity to the Canadian, to the banks during the pandemic. Government of Canada has done its best to avoid depression. So I think you have some responsibility in your members to accommodate your clients and at least not charge any fees. You can have a written answer if you want.
Great, thank you. First, about variable rate fixed payment mortgages. I think you saw a number of borrowers go into variable rate mortgages because the economic incentives were there. Because of the structure of the MQR, an individual can qualify more for a variable rate mortgage than a fixed rate mortgage. But that's the structure of the MQR. The MQR is reviewed once a year by OSFI. Our recommendation, what we believe is the MQR is something that we're supportive of, something that works, but there's an opportunity to improve it. And that improvement is around...
I want to interrupt you because, it was the incentive of the banks and the employees that go variable rate because you will be qualified. Otherwise, you will not be qualified. So quite frankly, I think the burden is more on the banks than the OSFI. You understand what I mean?
Yeah, but...
It was a bias to influence the clients to choose the variable rates. Otherwise, they will not be qualified for the loan. That's what you mentioned, basically.
There was an incentive for individuals to take out variable rate mortgages, Senator. Like I said, bank employees, when providing their customers with mortgages, educate them, provide the proper disclosures. They sit down and talk about the costs and benefits. There's information on their websites about the various mortgage products, so they're able to have that discussion. But ultimately, it's the decision of the borrower to decide which product they want. Historically, variable rate mortgages have been quite beneficial for individuals. In fact, they come out of ahead typically. They're able to pay more of their principal off rather than less as a result of variable rate mortgages. What I'm saying is during the pandemic, variable rate mortgages and the application of the MQR favored variable rate mortgages versus fixed rate mortgages. That was the structure, but that's because of the structure of the MQR, not because of anything that the banks were doing. And all I'm saying is if you want to improve the MQR, have that review of the MQR happen more regularly than annually, because that delta between the fixed rate and the variable rate products for mortgages was around for quite some time.
Okay, let me interrupt you. Is it true or not that the B20 rule apply because they have no negotiation power with the banks if they want to change the condition, because the B20 rule apply if you change the banks? So yeah. My point, is it true that the B20 rule will apply since the first time buyer who want to change the condition have no significant bargaining power with the bank because the other bank will refuse. We are not qualified with the current interest rate that we have. So do you recommend are you ready to recommend to your members to have a moratoire at least for the next 2 years regarding the fees related to external amortization or to accommodate your clients?
Actually, for insured mortgages, and those are the mortgages that first-time home buyers are typically use because of the low LTV and the low down payments required. there is no requirement to apply a MQR when switching mortgages.
But it's maximum 25 years for insured mortgages, you know.
Yeah, those,
Because him and she do not allow more than 25 years amortization on insured mortgage. So a lot of folks currently, 2/3 right now of their variable rate fixed payment are more than 30 years amortization. So if they are forced to be back to 25 years, forget it. They will have to give the keys back.
banks, like I said, banks are proactively reaching out to their customers and helping their borrowers out, and there's lots of ways that they do that.
Yeah, my question is about fees. Are you ready to recommend you will have no fees to accommodate your clients? Because if they are back to original, they will not be able to meet. And if they change the condition, they have some fees associated to that usually.
Like I said, banks are withstand and are aligned with FCAC requirements. So they provide disclosure around fees. They disclose and they're very transparent in terms of what those fees are. In terms of moving into a fixed rate mortgage, typically no fees are attached to that. So.
Let's try the question this way. You are the Bankers Association here. Do you ever give your members advice and say it might be a good idea to have a moratorium for the next 2 years and reduce fees? Or are you a product of what they tell you their collective positions is?
Now, we as an organization, we do not tell our members what to do. And in fact, Competition Bureau prevents us from getting together and talking about fees, or negotiating around fees. So we're not in that position to do that. We can't. It's against competition rules.
Okay, I want to ask another point then about which also might be a conflict